This is the Investor Connect podcast program. I'm Hall T. Martin. I'm the host of this show in which we interview angel investors, venture capital, family offices, private equity, and many other investors for early stage and growth companies. I hope you enjoy this episode. Investor Connect is a 501c3 nonprofit dedicated to the education of investors and startups for fundraising. Please consider donating $100 to the program to help others in their investor and entrepreneur journey. You can find the donate button on the investorconnect.org website. Well, hello, this is Hall Martin with Investor Connect. Today we're here with Yao Huang of Divison Capital. Divison Capital is a purchase order receivables purchasing fund that makes capital available to minority and women-owned businesses so they can grow and realize their potential. Yao, thank you for joining us.
Yeah, pleasure.
Great. So where are you calling from today?
I am in Chicago.
Great. Well, good. So let's start off with your background. What were you doing before joining Divison Capital?
2 decades of tech and venture, building companies to invest in them, and special place in my heart for the underdog.
That's great. So what excites you right now?
Making capital available to as many people as possible, especially those that may have been, biased from venture or from banks, creating new sources besides equity-based financing. And so there's a whole backstory as to how this all started.
Well, great. Well, before we get into that, let's tell me more about your advice for people investing in startups. You see a lot of people investing out there. What do you tell them to do before they write that check?
Yeah, I have a lot of years in startups. This fund isn't necessarily for startups per se. We can get into that a little later, but investing in startups in general, you look at the founder, you look at, these days, it's fairly simple to get product, at least minimal viable product up and running. So see if you can get some traction, 1 customer, 2 customers, especially if it's enterprise, or get a couple hundred if it's consumer, something moving to prove that this is going somewhere. Defensible IP if you have that, and just a roadmap experience. I think it's not as hard as it used to be because a lot of the technical infrastructure is there, and that's getting more and more scalable these days. I find a lot of it to do with the business.
Well, great. Then on the other side of that table, what's your advice for founders? What do you tell them to do before they go out to raise funding?
Get some customers, generate some revenues, and then something to talk about besides this picture on your deck. And honestly, if you're fundraising, you should have talked to those investors in the beginning. Just socializing without asking for money, keeping them abreast, showing them what's happening, so that when it's time to pull the trigger, they already know. And it's much easier than starting from scratch at the moment that you are ready. So it's kind of like making friends before you're ready to raise.
Well, great. Well, let's go back to that history behind Divison Capital, behind your current fund and how you came to it. What's the backstory there?
So again, I've been in venture for a long time, and it's not capital that's meant for everyone. It's meant for about 2% of companies. So there's 98% that this kind of money doesn't touch, but this kind of money, this venture money, is very sexy. It's in movies, it's in books, you read about it in articles everywhere, it's all over the internet. Wow, you're really famous, you're a founder that got funded, which doesn't mean anything, it means that you owe a lot of money later. And traditional businesses, which used to have some, story to support, has fallen by the wayside to tech companies and this whole story of Facebook and Zuckerberg and all those types. And there are groups like women that have been biased or underserved. And of venture capital's all assets combined, all funds combined, only 2% go to women. And similar stats for minorities. And that number hasn't changed. In fact, it's declined as of recent. And so there's a lot of people, working for that, starting more funds that make capital available, more LPs, extending to first-time partners that are women or minority, but that number isn't changing. And I would like to see some movement that opens up availability to more people. That's not going to happen in my lifetime. If they double this will go to 4%. Double that, it'll go to 8%. So that doesn't really make much of a difference. And I'd like to do something. So we spent a lot of time looking at where we can place capital. And the other end of it would be debt. If you look at that, well, there's banks out there. Banks don't really lend to a lot of minority and women, things that don't look the same. There's a lot of bias, there's a lot of research behind that. And so then you look at businesses, what makes it less risky? Well, if you have big accounts, like corporate accounts, like government accounts, you get a contract from one of them, it really defines your business. In fact, they're usually large 7-figure contracts, 8-figure, 9-figure contracts. It's game changing and they're pretty solid. There's a nice moat around it. It's difficult to get. And they do a lot of diligence, meaning the companies are established. They are able to service those contracts, deliver, whether it be product or service. And I'm like, wow, that's really good. Why don't we look at companies that have some of these contracts? And the least riskiest among those two buckets are government contracts. So we spent a lot of time looking at companies with government contracts. Turns out the government takes a long time to pay. It could be a month, 3 months, upwards of 9, 12 months before they'll pay the bill. So now you're fronting the cash flow. And those kind of starts out as a purchase order once you win the contract, purchase order. Banks don't lend against that. So now you have another problem for these founders, for these company owners. And they're not always an AI tech company. Yes, there are software, there's IT, but there's also janitorial, there's construction, there's lawn care service, there's everything. And not a lot of time or mind space is spent thinking about these kind of companies. And there's so many of them across the United States. So we spend a lot of time thinking about who we want to help, where we want to go, partnering up with different cities. One of the reasons I'm here in Chicago, and trying to make it as fair as possible to get capital out there.
And so
maybe create some.
So how does a limited partner make a return on this type of investment?
Like most do. There's profits, and in this case, there's profit sharing. So I don't want to go into term sheets on this video, but if they're interested, we have a whole set right there. But it's quarterly returns versus waiting at venture. You have to wait till 7 years after exits happen. This is something that actually can happen much faster.
Right. Okay, so they're taking a portion of the profit from the project, unlike venture, where we sell the business and then we all divide up the returns that come from selling the business.
This is in PO finance. We buy the receivables on a discount, so we wait for the payer to pay. When that happens, we have fees associated with that, and that over time, over a fund of $100 million, that adds up.
And so what are the challenges in putting this fund together? On the investment side, what challenges have you encountered and how did you overcome them?
Investment side, not so much, mainly because this kind of fund is not driven by the stock market. So right now we're going into a recession. Everyone's all scared. This is not touched by that. This is stable, regular returns. We've limited the risk by working with the government, and there are risks associated with this, as there is with anything, but not from receiving of capital. We've been pretty fortunate there. But if you're talking about risks in making these investments, the biggest one would be that the government doesn't pay because you didn't complete the task. And then we have risk mitigators for that as well. But so there's ways to balance all the components of this. This is actually, in fact, one of the oldest forms of capital. Been around for hundreds of years. It's not very sexy, but it's still an area that hasn't grown very much because it's mostly private money. Most funds are 30 million lower. It's not very large. They tend to be very niche. They're not well understood by founders. They don't really go out and it's not easy to find these. It's still based on paper. There's a lot of just old traditionalness to it that I think we'd like to overcome for everyone.
Right. And for the women startup that you're supporting, how do they benefit from this?
We are giving preference to women founders and minority-based founders.
Mm-hmm.
So where you could not borrow from a bank, where capital is not available to you in other ways, this is. Go get a piece of business and we'll help you out.
Well, that's great. So you've got this running in many cities. How's it going so far?
Great. I mean, cities love it because it's aligned to their minority and women initiatives. The city of Chicago, for example, is trying to hit a 26% minority vendor pool, trying to hit a 2% women vendor pool. And in order to do that, these businesses need to be able to carry the cash flow. If cities are taking a long time to pay, those businesses are fronting the salaries, the benefits, the expenses, and not everyone can do that. And so they need organizations like ours to help float until the bill comes through.
Great. And after government contracts, what would be the next one in line that you would go after?
Working with city and states right now, the next one would be federal. We're also finding a way to help nonprofits that get grants. Same problem. In some cases, these nonprofits don't get the funding until after they complete the requirements. So let's say the nonprofit's helping to feed the poor. You have to feed them first before they'll get the grant, which is very not intuitive, but they can't get bank loans for that. We're working on a way to step in for that as well.
Great. Well, you're doing some fantastic work there. In the last few minutes that we have, what else should we cover that we haven't?
I mean, we're super excited about this. If there's interest in participating as an investor, or if you have cities that want to get involved, we're happy to. We have capital that can extend up to $75 million per city as long as there's interest. And for owners, founders, companies, small and medium sized, we're open to hearing from you.
That's great. So how best for listeners to get back in touch with you?
Pretty accessible. There's a website, division1capital.com. You can email us from there. And I think you have some email addresses to share as well.
That's great. We'll put that in the show notes. I want to thank you for joining us today and hope to have you back for a follow-up soon.
Sure. Thanks.
Investor Connect helps investors interested in startup funding. In this podcast series, experienced investors share their experience and advice. You can learn more at investorconnect.org. Paul T. Martin is the director of Investor Connect, which is a 501c3 nonprofit dedicated to the education of investors for early-stage funding. All opinions expressed by Hall and podcast guests are solely their own opinions and do not reflect the opinion of Investor Connect. This podcast is for informational purposes only and should not be relied upon as a basis for investment decisions.